Why Gen Z is abandoning traditional investments. In 2026, what if the next financial crisis is not a market crash, but a generational rebellion? What if the traditional blueprint for building wealth, the one built on index funds, pensions, and property, is quietly being rewritten, not by Wall Street, not by governments, but by a generation that grew up in crisis? In 2026, Gen Z is not investing the way their parents did. They are reallocating trillions of dollars away from traditional assets and into something entirely different: crypto, tokenized ownership, creator equity, digital real estate, AI-driven income streams. This is not hype, it is structural. And even the world's most powerful financial leaders are taking notice. Larry Fink, CEO of BlackRock, has warned about intergenerational economic anxiety and the need to rethink retirement systems for a new era. So the question is no longer, why is Gen Z abandoning traditional investments? The real question is, are they wrong or are they early? Tonight, we break down the data, the psychology, the risks, the opportunities, and what this generational shift means for your money, the economic inheritance. Every generation invests according to its scars. The silent generation trusted savings accounts. Baby boomers trusted property. Gen X trusted diversification. Millennials trusted tech stocks. Gen Z trusts flexibility. To understand why, we must rewind. The first shock, 2008. Many members of Gen Z were children during the global financial crisis. But they remember something: stress, foreclosures, parents losing jobs, conversations about money becoming tense. The collapse of major institutions left a deep imprint. The message absorbed subconsciously was simple: the system is not guaranteed. Financial institutions once seen as permanent suddenly disappeared. Trust cracked. The second shock, the pandemic. Then came COVID-19, global shutdowns, supply chain collapses, government stimulus, markets crashing, then rebounding at record speed. Young investors watched. Entire industries close overnight. Governments print trillions. Tech stocks soar. Meme stocks explode. Crypto multiply. Volatility was not an exception. It became the norm. Inflation returns. For decades, inflation was relatively contained in many developed economies. Then prices surged. Groceries, rent, energy, insurance. For younger workers, wages did not rise proportionally. Traditional long-term compounding feels less comforting when present costs rise aggressively. Housing. The Great Barrier. Homeownership was once the foundation of middle-class wealth. But today, down payments are historically high. Urban home prices have dramatically increased. Mortgage rates fluctuate unpredictably. Without access to property, wealth-building pathways narrow. Even leaders at institutions like the International Monetary Fund have acknowledged housing affordability as a structural economic issue. When foundational assets become inaccessible, innovation emerges. Intergenerational wealth tension. In annual letters to investors, Larry Fink has written about the need to rethink retirement systems and long-term savings structures. He noted that younger generations face legitimate economic anxiety and that the traditional retirement model must evolve. This is significant. When the CEO of the world's largest asset manager signals structural tension, markets listen. At forums like the World Economic Forum, policymakers increasingly discuss generational wealth divides and financial inclusion gaps. This is no longer fringe commentary. It is institutional acknowledgement. The psychology shift. Traditional investing was built on patience, stability, predictability. Gen Z grew up with speed, disruption, algorithmic change. They do not reject compounding. They reject rigidity. Instead of retire at 65, many prefer financial flexibility by 30, multiple income streams, asset liquidity, geographic independence. This shift is philosophical, before it is financial. Technology as equalizer. Unlike previous generations, Gen Z entered adulthood with commission-free trading, global investing apps, instant market data, Social investing communities, barriers collapsed, information democratized, participation expanded, markets became interactive. And when systems become interactive, behavior changes. Institutional recognition of digital assets. Even regulatory bodies like the U.S. Securities and Exchange Commission have expanded oversight and engagement with digital assets. Meanwhile, large firms including BlackRock have launched crypto-related products and discussed tokenization as a future infrastructure layer for markets. When institutions adopt what was once considered fringe, generational shifts gain validation. The trust equation. Trust is the invisible currency of finance. Gen Z's trust matrix looks different. Less blind trust in institutions. More trust in transparency. More trust in technology. More trust in peer networks. This does not mean naive optimism. It means distributed confidence. And distributed confidence leads to distributed capital allocation, a structural turning point. What we are witnessing in 2026 is not merely preference. It is structural adaptation. When economic conditions change, capital behavior changes. When access changes, strategy changes. When technology changes, ownership changes. The question is no longer whether Gen Z is shifting. The question is, how far will it go? The portfolio that built the 20th century, and why? Gen Z questions one. For decades, one investment strategy dominated financial planning. The 60-40 portfolio, 60% in equities, 40% in bonds. Simple, diversified, reliable. It became the default advice from financial advisors, retirement planners, and pension funds across developed economies. And for much of the late 20th century, it worked. But in the early 2020s, something changed, and Gen Z noticed. The historical power of 60-40. To understand why this portfolio became iconic, we need context. From the early 1980s through the 2010s, interest rates steadily declined. Bonds delivered strong capital appreciation. Stocks benefited from globalization and technological expansion. Inflation remained relatively contained. This created a powerful tailwind. Stocks provided growth. Bonds provided stability. And when stocks fell, bonds often rose. That negative correlation was the secret ingredient. It made diversification effective. For decades, investors experienced what felt like a law of nature. Markets recover. Time smooths volatility. Patience wins. But economic regimes change. And when interest rates approach zero, bonds lose their protective power. The bond shock. In 2022 and 2023, bond markets experienced one of their worst downturns in modern history. Rising inflation forced central banks to hike interest rates aggressively. When rates rise, bond prices fall. Suddenly, the safe portion of portfolios was not safe. Stocks fell. Bonds fell. Correlation broke. For younger investors watching this unfold in real time on their phones, the message was clear. The old playbook is not invincible. When both sides of the 60-40 portfolio decline together, confidence erodes. And for a generation that already grew up in volatility, this was confirmation bias. Inflation changes everything. Inflation is not just a macroeconomic statistic. It is psychological. When rent increases 20% in 2 years, when groceries cost noticeably more every month, when wages lag behind cost of living growth, long-term investment promises feel abstract. Traditional portfolios assume moderate inflation and stable purchasing power. But after the global stimulus response to COVID-19, inflation surged in many economies. Central banks responded by tightening policy. And young investors learned something crucial. Monetary policy shapes markets more than financial textbooks admit. This realization changed behavior. The retirement illusion. Traditional investing culture is anchored in retirement. Contribute to pension accounts. Max out tax-advantaged savings. Let compounding do the work. But Gen Z faces demographic and structural realities that complicate this model. Many developed countries are experiencing aging populations. Public pension systems are under strain. Work patterns are shifting toward freelancing, gig work, and remote income. Even Larry Fink has repeatedly argued that retirement systems must be modernized to reflect longer lifespans, evolving labor markets. In one of his annual letters, he emphasized that people are living longer, but not necessarily saving enough, and that governments must rethink retirement design. For Gen Z, the message is interpreted differently. If systems are under strain, diversification beyond them becomes logical. The data behind skepticism. Let us examine the performance psychology. From 2010 to 2020, technology stocks massively outperformed broad market averages. Companies like Apple Inc., Amazon, Tesla deliver exponential returns. Meanwhile, bonds produced modest yields that continued shrinking. Younger investors did not see bonds as wealth builders. They saw them as slow. When risk assets outperform dramatically for a decade, risk tolerance expands. Then came crypto, the rise of asymmetric returns. In the early 2010s, Bitcoin traded for a few dollars. By the early 2020s, it had reached tens of thousands per coin at its peaks. Similarly, Ethereum created entirely new ecosystems of decentralized applications. For Gen Z, the contrast was stark. Traditional portfolios offered gradual compounding. Digital assets offered exponential upside, albeit with volatility. The 60-40 model felt like driving 40 miles per hour on a highway where others were racing at 120. Even if the risks were high, the potential rewards were visible. Correlation breakdown and the trust crisis. The power of 60-40 relied on negative correlation between stocks and bonds. But during inflationary shocks, both can decline together. This happened in recent years. For younger investors, diversification seemed less effective. Protection seemed weaker. Predictability seemed outdated. Hedge does not mean diversification stopped working. It means its psychological power diminished. Markets are not only about math. They are about perception. The housing equation revisited. Traditionally, property functioned as a parallel asset class. But for many Gen Z investors, buying a home requires massive down payments, long-term debt commitments, geographic stability. In the remote-first world, mobility matters. If career opportunities are global and digital, locking capital into a physical location may feel restrictive. Instead, fractional real estate platforms allow exposure without permanence. This is not anti-property. It is pro-liquidity. Institutional signals. Institutions are not ignoring this shift. Firms like BlackRock have publicly discussed tokenization, the idea that stocks, bonds, and even real estate could eventually exist on blockchain infrastructure. Larry Fink described tokenization as a next evolution in financial markets, suggesting it could reduce friction and expand access. When the largest asset manager in the world explores blockchain integration, it validates Gen Z's instinct that digital finance is not temporary. Meanwhile, policymakers at institutions like the International Monetary Fund and discussions at the World Economic Forum increasingly acknowledge digital assets as structural components of future markets. This convergence matters. It signals that generational experimentation may evolve into mainstream infrastructure. Risk perception gap. Older investors often prioritize capital preservation. Gen Z often prioritizes opportunity cost. To an investor in their 60s, losing 20% is devastating. To an investor in their 20s, missing a 300% opportunity feels worse. Time horizon changes risk calculus. This explains higher crypto allocation, more active trading, participation in startup equity, comfort with volatility. They are optimizing for growth, not stability. The behavioral finance layer. There is also a psychological element. Gen Z grew up with real-time feedback, algorithmic feeds, gamified systems. Trading apps provide instant execution, visual analytics, community discussion. Markets became interactive experiences rather than distant institutions. This increases engagement, but it also increases overtrading risk. Behavioral biases such as herd behavior, confirmation bias, fear of missing out, can amplify volatility. The same tools that democratize finance can also magnify mistakes. The pension question. Public pension systems across many developed nations face demographic strain. Fewer workers support more retirees. Longer life expectancy increases payout obligations. Even though reforms are ongoing, younger workers often doubt long-term sustainability. This does not mean collapse is inevitable. It means confidence is lower. When confidence declines, private diversification rises. The new allocation model, instead of 60-40, many younger investors follow something more fluid. For example, 40% broad equity, exchange-traded funds, 20% crypto, 10% private equity or crowdfunding, 10% cash, 10% skill investment, 10% high-growth stocks. These allocations vary widely, but the philosophy is clear: hybrid exposure, not rejection of traditional assets, but reduction of dependence. Is the 60-40 portfolio dead? No. It still provides diversification benefits. It remains foundational for many institutions. But its cultural dominance is fading. In a world of digital assets, tokenized securities, AI-driven markets, decentralized finance, the idea that one static allocation suits all generations seems outdated. Gen Z is not declaring war on diversification. They are demanding adaptability, a structural transition, not a collapse. History shows that portfolio theory evolves. Before the 1950s, diversification was less formalized. Then modern portfolio theory emerged. Then index funds democratized access. Now tokenization and digital assets may represent the next evolution. This is progression, not destruction. The question becomes, what replaces 60-40 as the cultural default? That is where we turn next. Gen Z did not wake up one morning and decide to abandon traditional investing. They were shaped into it by crisis, by inflation, by housing barriers, in part institutional strain. They inherited volatility and adapted accordingly. We have seen the emotional and structural inheritance. We have revealed the weakening confidence in the traditional 60-40 model. The truth is not that diversification stopped working. The truth is that economic regimes change, and every generation recalibrates. The 60-40 portfolio built the late 20th century. But 2026 is not 1986. Interest rates are different. Technology is different. Work is different. Access is different. And perhaps most importantly, trust is different. Gen Z is not rejecting wealth creation. They are redefining how it is built, and the most important question now becomes, why are pulling capital away from traditional models? Where exactly is it going? Before we move into next episode, take a moment, because what we are about to explore is not theory. It is real money, real platforms, real allocations, and real risk. If you are finding this breakdown valuable and you want deep, balanced financial analysis without hype, make sure you subscribe. This channel is about clarity, not noise. Hit subscribe. Turn on notifications. Because understanding generational money shifts is not optional anymore, it is essential. Now, thank you for watching. In the next episode, we will continue following the money and break down exactly where this generational shift leads next. See you in the next episode.